Hi class. Today we're going to talk through lecture 27, the cost of capital approach. So we're going to think about how do we actually figure out whether we want debt or equity or a combination numerically. In the prior exercises, we thought about these advantages and disadvantages in more like a qualitative sense. And today we're actually going to start going through the estimation. Now there's really two different approaches to figuring out the optimal capital structure, meaning the optimal mix of debt and equity. The first is the cost of capital approach. So the optimal debt ratio is the one that minimizes the cost of capital for a firm. Because you're minimizing the cost of capital, you're actually maximizing the net present value of the firm, because the cost of capital is in the bottom half of the fraction. The alternative is the sector approach. The optimal debt ratio is the one that brings the firm closest to its peer groups in terms of finance mix. Now we'll talk about this in just a few lectures. However, it's quite similar to the relative valuation approach, right? We're trying to figure out what is the fair debt ratio based on similar types of assets. So the cost of capital approach is quite straightforward. The value of a firm is equal to the present values of the cash flows, right? We saw this with valuation, and we've really been working with this since day one. Now, if the cash flows of the firm are held constant, and the cost of capital is minimized, then the value of the firm will be maximized. So in other words, if you make the cost of capital as small as possible, you're making the value of the firm as large as possible. So let's think through this. We could consider a range of different possible debt to capital ratios. So if you look at this table, we have debt to capital ratios of 0, 10, 20, all the way up to 100%. And under each scenario, we can figure out what is the cost of equity, what is the hypothetical cost of debt. We can take the weight to figure out the cost of capital. And then we can actually estimate the firm value if we also know what is the cash flows next year. And as you can see in the equation at the bottom right, this is what we're thinking of to estimating firm value. Expected cash flows next year, which are just cash flows this year multiplied by 1 plus the growth rate, divided by the cost of capital minus G. So the cost of capital is only coming into play here, but if we're making this as small as possible, the firm value should be as large as possible. So let's think through each of these. What we're seeing is that as we increase debt, we're increasing the cost of equity. The reason, as we'll see in just a couple slides, is that this is being driven by the unlevered beta moving towards a larger and larger levered beta, right? Because as you increase the leverage, the beta is also going to increase. And as you increase the beta, you're going to find a larger cost of equity. We're then going to also see that as we increase the debt to equity ratio, we're getting a larger after-tax cost of debt. And this is because as you take on more debt, the debt holders are at more risk, right? It's more likely that they won't be paid in the future, and so you need to compensate them for that additional risk. We also see this alternatively when we estimate synthetic ratings, right? To estimate the synthetic ratings from a few weeks ago, right, back at the end of the material before the test one, what we saw is that we estimate what are the interest expenses, right, per dollar of EBIT. And interest expenses are going to increase as the amount of debt increases. Now, when you estimate the cost of capital, right, it's not the case that just because cost of equity and cost of debt are increasing, the cost of capital is increasing. It's actually not, as you can see. And the reason is because while both of these are increasing, cost of equity and cost of debt, you're putting more weight on the cheaper one, right? Cost of debt is generally cheaper in every scenario. So you're putting more weight on it, right? Here you have no debt, right? Here you have 50%, here you have all debt. And so these two things are going to kind of cancel out eventually, right? You're putting more weight on the cheaper thing, but both equity and debt are also becoming more expensive. If we look at the cost of capital, what we see is that cost of capital slowly decreases up to 40% debt to capital. And then it starts increasing. So what this is telling us is that according to this, the cost of capital that's lowest happens when the debt to capital ratio is 40%. Because the cost of capital is affecting the firm value through this equation, what we also see is that this is the largest firm value, right? The firm value is maximized when the cost of capital is minimized. Now to see a similar graph, the pink-purple line is the cost of capital. And so as we increase the debt to capital ratio, right, from 0 to 100%, what we find is that the cost of capital decreases up to a certain optimal and then starts increasing again. And it increases fairly drastically, as you can see. So what this should mean is that this is your optimal capital because this is when you're maximizing firm value. And if we look at the blue lines, the blue bars actually tell us the firm value. We see that firm value is indeed maximized at 50%. So let's work this through in the case of Disney. We've already estimated what the cost of capital for Disney is several times. Again, the cost of equity is going to be estimated to be 8.52% based on CAPM, because we're getting a risk-free rate here, a beta here, and a risk premium here. The after-tax cost of debt is estimated to be 3.75 multiplied by 1 minus the tax rate, which is 2.4%. And then based on the equity and debt levels, we can actually estimate the weights on equity and the weights on debt. And we're left with 7.8% cost of capital. Now, in order to estimate what is the optimal cost of capital, we're actually going to have to do this calculation several times, right? So in the examples we saw before, we saw we're doing this for each kind of 10, 20, up to 100% debt to capital. And if we do it this way, we actually need to estimate these separate as well. So we need to do this exercise 10 different times. The first step is to estimate the cost of equity at different levels. And equity will become riskier. We'll see that as the beta will be larger, and therefore the cost of equity will increase. So we're going to use the levered beta calculation from test 1. The second step is to estimate the cost of debt at different levels of debt. So default risk goes up when you take on more debt. The bond ratings were therefore going to go down. When bond ratings go down, cost of debt will increase. To estimate these bond ratings, we need to use the interest coverage ratio, EBIT over interest expense. Because again, what we need to see is we need to see what is the hypothetical bond rating, right? So we actually don't know what the hypothetical bond rating is for Disney at different levels. So we're going to need to make it up ourselves. That's why we need the synthetic rating. The third step is to estimate the cost of capital at different levels of debt. And the fourth is to estimate the effect on firm value and stock price. Step 4 we will do in the next 2 lectures. So first, let's lay the groundwork. Estimate the levered beta for the firm. So we can use 2 different betas. One beta we can use is the regression beta, which was 1.25 for Disney. And then we can unlever that using the unlevered beta formula. If we do that, we can figure out the unlevered beta is 1.11. An alternative is to actually use the business betas, right? The bottom-up betas. And so we take the average of all the different components of Disney, and then we figure out the unlevered beta from those. So these are the unlevered betas for each area. We're going to figure out how important each of these areas are, right, based on the value of the business. And then using this information, right, we're going to weight each of these unlevered betas to figure out what is the total unlevered beta. And that's going to give us a slightly different number. So rather than 1.11, we're left at 0.92. We're going to use this for our calculations because, as we've argued, the bottom-up beta is usually kind of the better measure. The second step we also need to do is to get Disney's current financials, because we need this in order to figure out what is going to be the synthetic ratings and therefore the hypothetical cost of debt. So we need to figure out what are interest expenses in particular. All right, so estimating the cost of equity. We're going to consider different debt to capital ratios. And each debt to capital ratio is going to tell us a different debt to equity ratio, right? So if you have a debt to capital ratio of 10%, that means your debt to equity ratio is going to be 11%. Under each debt to equity ratio, we can now figure out what is the levered beta based on the unlevered beta of 0.9239. And we're doing that based on this formula here, right? We're going to take the unlevered beta multiplied by 1 plus 1 minus the tax rate multiplied by the debt to equity ratio. Now, as you can see here, the levered beta is the same as the unlevered beta. And that makes sense because this is the debt to equity ratio of 0, right? So the levered beta is the unlevered beta by definition. Once we do this for each time, what we'll see is that the levered beta is always going to uniformly increase. It's actually going to increase fairly slowly until the end when it actually moves very quickly. So these are very high betas. We then are going to use the CAPM equation. So use the risk-free rate plus the levered beta multiplied by the equity risk premium. And we do this, this gives us the cost of equity. Again, because the levered beta is increased, the cost of equity is going to increase fairly slowly at first and then very high at the end. So here we actually find very high cost of equities of 39%, 22%. To estimate the cost of debt, what we need to do ultimately is figure out what is the rating under different debt to equity ratios. So for instance, let's start with the debt to equity ratio of 0%. That's going to give us a debt to equity ratio of also 0%. And that's going to give us a debt in terms of dollars of 0. If we do this, we can then look at, we can take EBITDA, depreciation, and EBIT. Now, because we're assuming cash flows are not changing at all whenever we change the debt to equity ratio, these are going to be constant for every single calculation. So we'll see this similarly here, right? And then we're going to figure out interest. Interest is going to be the pre-tax cost of debt multiplied by the amount of debt. Since the amount of debt is 0, the interest is just going to be 0. And based on this information, right, the pre-tax interest coverage ratio is just always going to be infinity, right? Because the interest coverage ratio is EBIT over interest expense, but interest expense is 0 here. That means that our likely rating is definitely AAA, and based on our ratings table, which we have in the following slide, right, a AAA rating is going to be 3.15%. So it's going to be the risk-free rate plus the spread. Next, let's consider a debt to capital ratio of 10%. Well, that means that we have a debt to equity ratio of 11.11, right? Because essentially that means the debt to equity ratio is 10 to 90, right? If this is 10, right, then equity has to be the remaining 90 or 11% debt to equity ratio. 10% of this amount in the firm, so right, of the value of the market value of the firm is going to be 13,784, and we got this number from this calculation above. Now we're going to use the same EBITDA, depreciation, and EBIT as before, and then we need to figure out the interest. The problem is we actually don't know the interest, the hypothetical interest, because we don't know what the rating is. But we don't know what the rating is because we don't know what interest is, right? So we actually have kind of this catch here. And what we're going to have to do is we're going to have to do a guess and check measure. We're going to have to guess what is the likely rating. Based on this rating, what is the interest coverage ratio? Sorry, what's the interest expense? Based on that, we can estimate what is the interest coverage ratio, and then we can confirm that we have the right rating. So based on our calculation from before, the likely rating, or the rating before was AAA. So we can guess that even if when we go up to 10%, we'll still be at AAA. Maybe we will, maybe we won't. So let's try. Based on a AAA rating, that would mean that our cost of debt pre-tax is 3.15. So we're going to take the pre-tax cost of debt, multiply it by the amount of debt, right, which is here, and that's going to give us an interest of 434. We're then going to estimate the interest coverage ratio as EBIT divided by interest expense, which is going to be 23.1. Based on the table, that's significantly higher than necessary for a AAA, so we have a AAA bond, and the pre-tax cost of debt is 3.15. Now here's the ratings tables that we've used. I think we've actually used this in a couple different ways. So I think depending on exactly what we assume about the bond rate, the interest rate is actually changing slightly. Right? So I think this actually does not fully agree with these calculations. However, the important thing is that the spread is constant, I think, anytime we'd use this, right? So we figure out what is the spread based on the interest coverage ratio, right? So here we saw an interest coverage ratio of 23. That means it's significantly above 8.5. We have a AAA rated bond. The spread is 0.4%. So this then takes us to the question for 27. We're actually going to break this into two different questions, or two different answers, as I'll show you. Thaddeus Inc. is a publicly traded chemical company with a bond rating of AA and a pre-tax cost of debt of 3.5% and its current debt-to-capital ratio of 40%. The firm is $400 million in debt, $600 million in equity. The firm has an operating income of $70 million and is considering borrowing $200 million and buying back the stock. If it does so, what will the interest coverage ratio for the firm be, assuming the firm's rating will drop to a BBB, and the interest for the BBB rated bonds is 5%. So we need to find a few different things, right? So what was the existing debt? The existing debt was $400 million, as we saw here. Next, what is the new debt? The new debt is $200 million. And then finally, we need to figure out what is the new interest expense. So it's going to be the 3.5% multiplied by 400 plus the 5% on the new bonds multiplied by the new $200 in debt. Multiplying that together and adding, we'll find that the interest expense is $24 million now. The second step is to estimate what is the interest coverage ratio. Interest coverage ratio, as we mentioned before, is EBIT over interest expense. EBIT was 70 million divided by 24 gives us an interest coverage ratio of 2.92. There is a complication, and this is something that probably is going to come out in the real world, which is that if you take on a large amount of debt like this, right, you went from 400 to 2 million to 600 million in total in debt, your original debt holders are not going to be very happy with this. And if there's certain covenants in place, right, or if they, or through the passage of time, they're simply going to eventually require that they also are paid the 5% interest, right? Because they're exposed to the same risks as the new debt holders. So they'll still want that same compensation for the same risk, which is 5% interest. So therefore, you're instead going to multiply the interest expense. To figure out interest expense, you're going to multiply the 5% multiplied by the total 600 million in debt. And that's going to leave you an interest expense of 30 instead of 24, and an interest coverage ratio of 2.33. So these are the answers, right? We're going to first estimate what is the interest expense based on the 400 original debt multiplied by 3.5 interest, the new $200 in debt multiplied by 5% interest, 24 million, plug in the interest coverage ratio. Alternatively, we're going to take all 600 million debt multiplied by the new 5% rate, find an interest expense of 30, plug it again to the interest expense ratio. This concludes lecture 27.